giving our lives to advancing Christ and advancing his kingdom in the earth, then we need to be a people that knows how to go out there and manage our own household and how to take care of the people in need. So I'll just read you a few verses that I had on my heart and talk about a little bit of stuff, and then we'll kind of dive into the nitty-gritty of the material. All right, let's go. I'm just going to read from 1 Timothy 5:8 down a few verses. But if anyone does not provide for his relatives, and especially for members of his household, he has denied the faith and is worse than an unbeliever. So right there, we're commanded to take care of ourselves and our household. I believe, that means our family, but I think it also could be extended out to the body of Christ as well. And then jumping passages over to Matthew 25:31 through 40. When the Son of Man comes in his glory and all the angels with him, when he will sit in his glorious throne before him, he will gather all the nations, and he will separate people one from another, as a shepherd separates the sheep from the goats, and he will place the sheep on the right and the goats on the left. Then the king will say to those on his right, "Come you, who are blessed of my Father, inherit the kingdom prepared for you from the foundations of the world." And then this is what he says, "For I was hungry, and you gave me food. I was thirsty, and you gave me drink. I was a stranger, and you welcomed me. And I was naked, and you clothed me. I was sick, and you visited me. I was in prison, and you came to me." Then the righteous will answer him, saying, "Lord, when did we see you hungry and feed you, or thirsty and give you drink? And when did we see you a stranger and welcome you, or naked and clothe you? And when did we see you sick or in prison and visit you?" And the king will answer them, "Truly, I say to you, as you did it to one of the least of these my brethren, you did it to me." And so I just want to encourage all of us to be those people that actually do that, so that when we come before the judgment of Christ, we'll be ready. And as Pastor Henderson was saying, our lives can be converted to, as I call it, liquid life money. It's just a liquid form. Liquid meaning it's transferable. You can go and work for an hour, get, $10, $15, $20, whatever you get an hour, and now you have it in a $20 bill, whatever it is, and you can hand that to somebody else. You give them part of your life because you exchange it. So I just want us to think about all the money we earn in that aspect, that if I spend $5, I've spent that much of my life. I've converted part of my life for whatever I just bought, whether it's that coffee, or whether it's the car, or it's your supper that we all need to eat. We got that. But I also want to remind you that God is the owner of everything, that we are just his servants, and so basically we're just people that manage his investment in us. We're his slaves on the earth that should be rendering to our master everything, and we need to be faithful in that. So we're basically kind of like God's asset managers on earth, from a finance term. So saying all that, just to preface this, we also need to be prepared for the future. And a lot of times, I think as Christians, we don't like talking about money very much, and we don't like talking about saving in that because we feel like we're just being greedy or trying to consume money on ourselves. But I think it's prudent to be prepared for, retirement, and be prepared so that when you get to retirement, you'll have enough money and enough assets to be able to take care of the other people around you, whether young or old, that still need help. So you can still be a giver and a contributor and still follow the Bible's encouragement of, a righteous man leaving an inheritance to his children's children. So let's see if this thing will put us in here. I'm not sure. Looks like it decided to turn off. I'm going to try to blow through a little bit quickly here some basic investment terminology so that you can hopefully understand a little bit better what I was saying, or what I will be saying, and you won't be hopefully as confused. So if you have questions, please go ahead and raise your hand and just throw it out there, because it doesn't do us any good for you not to be understanding what I'm talking about. That's interesting. So basically, there's all these vehicles, as you call them, for investing. You can invest in stocks, which makes you an owner of that company. And ways to profit by owning stocks is the price increases from the time you purchase it to the time that you sell it. Dividends are disbursements of, usually in the form of cash, although they can give you an extra share of the company that makes you a greater percentage owner. And the way the company gets those shares back is they think that the share is undervalued on the market and they go and buy it to then give you a piece of it. So it's a way that companies increase the value of their stock. Risks of owning stock, price of stock can decrease, or the company can go out of business, resulting in total loss. So a lot of these numbers we're going to talk about, you need to be aware that past performance, as they say in the investing market, is not a guarantee of success or future outcomes. So if the company goes broke that you invested in, that money's gone. And you get the premium or the return off of it based on the risk you're putting out there for it. There can be profits or downturns resulting in low dividends, or dividends can be completely canceled, meaning the amount that they're paying you yearly or whatever, those are discretionary because you're an owner. And if the business isn't giving you money, you're not going to get paid. Poor selection of stock resulting in underperformance, you lose opportunity because if there was another stock that was good, you missed it. All right, bonds, you're essentially lending money to people or the government or really any kind of entity. There's all these strange kinds of entities out there that you can invest in, such as real estate trusts. So you could go own part of Fayette Mall if you wanted, or you could own part of lots of factories, warehouses, farms, whatever you wanted to invest in. Ways of profit from owning bonds, periodic interest payments, usually semi-annually. Once in a while you get them quarterly. So what it is, you give them so much money, generally $1,000, and they'll agree to pay you 4% for the next 10 years. And then at the end of those 10 years, they hand you back your $10,000. But you generally get a lot lower return because you're not actually an owner. You're only a person that's investing in it. And as long as they don't go bankrupt, you're going to get your money back. And if they do go bankrupt, you have access to more of the money because you're the first person to get paid because you're a debtor. You're not an owner. All right. So we've kind of talked about some of the risks of it. Oh, there's interest rate risks as well in owning bonds. Because if you wanted to sell your bond before it comes due, and the interest rates have gone up a lot since you bought the bond, then the value of your bond's down a lot because them owning it, they could go out and buy a better one on the market today. So it's kind of like an opportunity cost, and it's the time value of money calculation. All right. All right, we got that. Move on. All right. So then you get into mutual funds, which are what most people invest in because they allow, I guess you would say, low amount of money to be invested at one time in a wide diversified pool, if that makes sense. So it's a pool of funds collected from many investors to purchase a diversified set of stocks or bonds. And then there's two primary kinds of mutual funds. Actively managed mutual funds are managed by investment professionals, generally attempting to outperform a certain sector of the market and avoid market downside. These funds buy and sell stocks and bonds seeking to select investments that will outperform the competitors. So they try to figure out, oh, this quarter Coke is going to make more money than Pepsi and their price is going to go up. So we're going to put a lot of money in Coke. And then next quarter they're like, oh my, GE is going to make a lot of money. I'm going to go buy a bunch of GE and sell your Coke. So they're moving this stuff all around trying to outperform. But historically, that doesn't perform very well at all because the costs are very high of buying and selling your commissions, and you have to pay these people that supposedly know a lot to buy and sell your funds all the time. Now, there are people that can give you certain, especially international portfolios, that do outperform pretty well because there's a lot of inequities, they call it, in the market. So there are places that having an actively managed fund could be worth an additional cost in owning one. But those would be more questions for an individualized assessment by a financial advisor. And tonight I'm not trying to give you like specific advice, just general information, so then you can Either go and speak to a financial advisor if you need to and get more detailed, or do the own research. Get better at it. All right. Exchange traded funds. These are one of my favorite investment options on the market, called ETFs. They're very similar to mutual funds, except they generally are just trying to match a benchmark or a certain section of the market. The main cost you have of buying ETFs generally is the ask-bid spread, which is the difference that the broker charges from, just say I one moment clicked sell a bond, how much they'd give me, and at the next, at the same time was purchasing them on another account from the same person, they would be different. And the broker keeps a very small margin of that. But it's not a big deal if you're not trading all day, which hopefully you shouldn't be if you're investing, as we'd recommend. All right. Also, ETFs allow you to get a very wide diversification without having a minimum purchase. For example, if you were to invest in Vanguard mutual funds, which there are some lower, but one of the lowest funds on the market for mutual funds, generally they have a $3,000 minimum to buy into a fund. So to get a portfolio that would be balanced across all sectors, you need probably between 9 and 12 funds. And so you can multiply that out times 3,000 and you need a big chunk of money to start. But with ETFs, you only need the amount for one ETF, which most of these are trading between $40 and about $160. So with around $1,000 to $1,500, you could purchase a completely diversified portfolio, but depends where you buy it to how much they require you to have a minimum to open it. Go ahead.
Can you explain the word diversified?
Diversification in this sense is, instead of you going out and buying a stock of Coca-Cola, you buy one of these ETF funds, say it's a S&P 500 fund, and you'd be buying a very minute piece of the 500 companies, U.S. companies that comprise the index S&P 500. And so if one of those companies went bankrupt, for example, you wouldn't even hardly notice it on your portfolio because it would be 1 out of 500 that had done it. And so it's essentially insignificant. And when they all rise, the value of them rises, your portfolio rises, and just say a few of them go up a lot and a few of them go down some, overall you just get the market's performance in the area of the market you invest in. So we're going to talk a little bit more about asset allocation and diversification in a while, which is, in my opinion, and I think most academic stuff I've read, the one way to make a higher return without increasing your risk. It usually decreases your risk, which you can measure in betas and standard deviations, which means the changes that they make on a given day. So say like Coca-Cola went down one day, maybe you can find another stock that historically, using statistics, you can find goes up almost every day that Coke goes down. But when you're using huge pools of portfolio, you can buy an international stock fund of, say, financials, and they generally go up when U.S. financials go down. So you could buy a bunch of banks in Australia through one of these funds. And so if the U.S. stock market's tanking, that's going to be going up. So your overall portfolio balances itself and just increases more. So you're trying to level it out. You don't want volatility where one day you look at your portfolio and say you had $10,000, the next day you look and you have $6,000. Of course, it doesn't generally happen that quickly, but over a couple of years it can. And we'll see some of those numbers. But we need to fly along here. All right, this thing got it right. All right. Investment considerations. Wall Street wants to help you invest so that they can make a profit off of commissions and fees, and so take their advice with a grain of salt. There's a lot of great advisors out there that will help you and that will charge you a reasonable fee. It may be a lot of money, but that doesn't mean it's not reasonable for what they're giving you of advice. But you have to realize there's also a lot of brokerage firms out there that are simply out hunting money. And they're just trying to find people that will invest with them, and they'll just put you in whatever fund gives them the biggest commission, or even gives you the fastest portfolio growth at a high risk if they're charging you a set fee. Because if, just say, a lot of companies now advertise, oh, on a $100,000 portfolio or something, we'll charge you 1% a year to manage that portfolio. But if your portfolio, say, goes from $100,000 to $125,000 really fast, now they're making a lot more money. So the critique of those type of fund payment is that oftentimes, a lot of them don't do it, but there is that incentive built in there. And as an accountant, conflicts of interest, I hate those things. They're terrible. Always avoid them. We'll talk about those more. All right, Main Street, your family and friends often give good advice based on their experience and perceptions are often biased or based on a single experience. So you need to follow informed advice. Because I know a lot of people that invest how their grandpa told them to. Which, I mean, you need to listen to wisdom, but also there's a lot of stuff that didn't exist when your grandpa was investing, most likely. So it might not also be the best investment anymore. There might be other regulations that now makes it almost obsolete, like CDs. You go pick up a book about 5 or 10 years old on investing, especially a lot of the Christian books about that old, and they talk about how you need to invest the majority of your money in laddered CDs. It's a guaranteed way currently to lose money. Guaranteed. Because inflation runs, if you do the CPI, about 3.5% a year, your money loses buying power. So every year, your money can buy about 3% less on average over the last 100 years. All right, a CD, go ahead. A CD is an insured deposit where you go to the bank and say, hey, I'll give you, usually it's $1,000 minimum. You give them $1,000 and they say, we guarantee to give you, nowadays it's like 1 or 2% if you're lucky. For a year, you usually lock into, and at the end of the year, you can get your money back out and they pay you that interest.
So you're losing money because your money
is losing buying power. So your dollars go up a little bit, but the number of dollars in your account goes up slower than the inflation. That's good.
Do you know what the difference is between the interest rate you would receive on a typical bond, maybe a government bond, and what you're talking about, like the average performance of the market? So like, is the stock market average significantly better than interest?
Absolutely, yeah. Currently, the U.S. government bonds, now if you buy, there's multiple kinds of bonds. I think the bond you're talking about is like a U.S. Treasury note. Is that what you're referring to?
Well, just I guess a typical bond that you could.
Okay, like a bond that would say is a government bond to build a road or a bridge or something. Most of those I've seen, if you buy a Kentucky bond right now, last time I was looking, they're 3 to about 5-6% tops. Most of them are probably in about 4% range right now. And those will fluctuate over the years and changing. And last year, the S&P 500, I'd have to look, it performed over 20%. I think it was about 23-24%, just the S&P index, which is not the top. So of course that's 1 year. That's not the annualized return, which we'll talk about in a little while. But it's nothing even close to it. All academics that I've ever read say, especially when you're young, you need to be in majority stock, if not all stocks. Because stocks give probably about a 4 to 5%, well, I'll quote Paul Merriman. I'll be talking a lot more about him in a little while. He's a former hedge fund owner. He now dedicates himself to just teaching investment advice, and he writes on the Wall Street Journal. He says that every 10% you increase your portfolio from even good bonds into equities. So say you had a 50-50 portfolio, and you decide now I'm going to make it a 60% stock portfolio, now only 40% bonds. That makes sense? You would increase your return on average by about 0.5% to 1%, annualized over whatever period, if you would pull it out of like a 40-year stock return. So you're losing a huge amount of money over a long time frame by being in bonds. And bonds actually recently have had worse default rates than stocks overall. Puerto Rico's gone under, Detroit's not paying their bonds. There's a lot of problems out there. Of course, you can avoid a lot of that by wise investing, but does that help? All right, we kind of need to scoot along a little bit. All right, and academic advice is generally, from my experience, the most accurate, as authors should not have conflicts of interest. such as profits from selling you a product. The only reason they would want to do it is maybe to sell you a book or something. I don't know. Following a research method of investing does not, of course, guarantee a positive outcome, but it increases your probability by a lot. Because you can do the numbers and see what it's done over the last 100 years, whatever. All right, so now this is where I'm getting to the actual question Pastor Henderson's wanted me to address. What happens when somebody walks up to you and says, hey, you've got an investment portfolio, can I help you manage it? This is what you should be thinking about whenever you decide to go there. What are the fees? These are generally the fees you need to look for in any investment you make, whether you do it yourself or you hire someone to do it. There's the same pool of them. There's management fees sometimes. There's loads or commissions, which are a certain percentage that they'll charge you generally to buy a mutual fund. So say you would go out and buy an American fund, those are oftentimes 3 to 6% of your initial investment will be skimmed off and paid to the advisor for recommending you to buy that fund. So those are really bad from a fee standpoint. Fund operating expenses, those are how much it costs to keep a mutual fund or an ETF, an exchange-traded fund, running a year. So there has to be somebody that does the accounting. There has to be somebody that buys and sells stocks. Because just think of all this room. If all of us decided to invest $500 over the next year in a particular, just S&P 500 index, that would be a lot of money going into that fund. And generally, there's billions of dollars going into funds. So they have to go out, and if you're buying the S&P 500 index, every day you buy $500, they've got to go buy that many more little pieces from all these other investments so that you can own a piece of 500 stocks. And when you sell your one share of this mutual fund that holds all these stocks inside of it, they have to sell something to give you that cash. So that's what an expense is. Now, on a mutual fund that is actively managed, that they're trying to move stuff around to beat the market. That's the idea behind actively managed mutual funds. The operating expense goes up because they're buying, selling, buying, selling, buying, selling, and you generally get hit really hard with taxes if you're not invested, for example, like in a Roth IRA or a traditional IRA, because they've been buying and selling, which realizes gains, which is what triggers the tax letter that you get every year from your investment portfolio, which is really bad. I mean, it can be hundreds of dollars easily if you have it can be very high percentage-wise, we'll just say that, based on your investment. So it's not an efficient way to do it. All right, trade fees. Those are generally more related to buying bonds, or even more so to stocks. There's a lot of brokerages out there. You can buy, 1 share or 100 shares of Coke, but per trade that you do with them, they charge you like a flat rate of say $5. There's some a little less, and there's some that go up to $15 a trade I've seen, easily. So you can lose a lot of money quickly, even just trying to invest little by little, because each time you go to invest, it costs you $5, $5. Do that over 40 years, you've lost a lot of money. All right, and also, if you buy certain types of shares, like their classes, they don't charge you as much to buy it, like they'll only have, say, free to buy it, but when you sell it, they charge you the commission on the back end. So those are like B or C shares of, say, American funds, MFS funds. There's lots of them. JP Morgan Chase, whatever. Those are the main things you need to look about. And so every fee you need to think about reduces the return on what you've put in. So every dollar that gets taken out is $1 less that you're going to have. So you need to be thinking about that a lot when you're investing, especially when you're on the low end of investing, starting out. You don't want to be getting into a type of investment style that eats up a lot of money for the rest of your life. All right. Okay, fee comparisons. I tried to get stuff relatively close in family. I didn't have time to go and get identical underlying funds, but you can't get identical, but very similar. So these are funds. Pastor Anderson asked me to grab an American fund. I took a Fidelity fund that's offered as part of the UK 401k plan, the T. Rowe Price one that Mr. Henderson has used, and a Vanguard International fund, which is highly recommended. They're trying to get them in the same sector, so they give a representative. And that annual operating expense, so this is how much comes out as a percentage of what you have invested per year in that fund. For American funds was 1.13%, Fidelity 1.38%, T. Rowe Price 0.5%, and Vanguard 0.43%. So that's a lot.
If Vanguard International is better for the consumer than Fidelity, then why does UK not do the best thing for the consumer?
That's a good question. There's going to be a lot of considerations in it. This is one fund that we picked in the same category. So they may go ahead and pull out another one in the portfolio that Fidelity is cheaper than Vanguard in the same asset class. It could happen. Because this is just one set of them. Each fund has a different cost. But generally Vanguard, Charles Schwab, and T. Rowe Price are currently selling the lowest cost funds on the market. And they come with no load and no extra fees at all. They don't charge you any fees. So you can just buy them and you just get that 4-3%, extremely low cost investing. But I'm not here to say go buy one company or another company. There's a group of companies that'll do very well for you. And then once you get a larger amount of money, it may be good for you to go to a financial advisor that can help you invest in funds that aren't even available without financial advisors that can give you access to even less expensive funds. Go ahead.
So what's a life fund?
Oh, generally, I'd say over 100,000. Probably $250,000 for really good ones. I haven't worked in a high-end investment firm, but that's what I've seen. So, yeah, 100,000 is not much money in the investing world. The difference expenses made. All right. Right here, I just took and made a comparison between the highest and lowest, the Vanguard fund, and that. And the difference came out to if you were investing a maximum into your single Roth IRA for 40 years, which equals $458 per month, and 9% return, which I think is lower than you could get, you would have $2,145,000 plus dollars. And if you took the fund with the lower expenses, assuming identical performance, which you won't get, but if you assume that, you have $2,854,000, which is $709,000 difference. That's huge. That's not including that if you get a better diversified portfolio, you can save a lot more money. That is just on, what is it, 0.95% difference in your expense ratio. And if you get a whole portfolio, that's really easy to reduce your expenses by moving to these type of funds. All right, look for, when selecting a financial advisor, let me highlight, look for potential conflicts of interest, which I've talked about. Is there a way that the financial advisor would have a financial incentive to sell you something that's not good? And there's illegal ways to protect yourself. Get financial advisors that are fiduciaries, which they sign that they legally commit themselves to giving you the best investment choice that they know of for your situation. Because if you go to a regular financial advisor that's not signing off as a fiduciary, they are only required to give you a suitable investment. Doesn't mean it's even great, just suitable for you. All right, we talked about that earlier. This is another question coming back to it. When you have a 401k, does it allow you to manage your own funds, or are you required to put it into a specific pool and have a specific person give you advice on it? A lot of employers require that. You're not allowed to essentially manage it yourself without the financial advisor's expenses. So say I go and start working for a company, and they've got this great 401k, they match, like if I contribute 3%, they also contribute 3% more in addition to that, which is awesome, because that's essentially getting 3% raise, in your pay, getting put towards your retirement, which, let me say, you should very strongly be doing that if you're not already, unless there's, some extenuating circumstance where the fees are so bad in your company, which I've seen a few of, that you shouldn't do that. But generally, you should be putting it in.
So if there's a match at all, don't even ask the question.
Well, you should look at it to make sure the fees aren't crazy, because I've seen some of them that your average cost, when you add up every cost that there is, because some of them have a flat advising fee that's just stuck in there. They have very expensive funds that have huge operating expenses, and they are putting in the funds that charge a load, which is that commission that can be up to 5%. So you could be losing more money than you'd be gaining in your match, potentially, but that's not normal. But there are out there, and there's plenty in this part of the country. I've seen plenty of people with that. So don't just throw your money at anything ever, but very, very strongly consider taking a match because it's free money. All right. I didn't get time to finish it, but I'm gonna make a little PDF list, and maybe Karen can help me send that out to you all if you want to see it, of just my favorite websites that I read to keep track of the stuff changing, if you're interested in that. And primarily my favorite person to read is Paul Merriman, as I'd mentioned him earlier. He has lots and lots of portfolio building tools, and he makes it even a lot easier to understand than I do. And he brings together tons and tons of research and makes it accessible for free, because he's just doing it in his retirement years. All right, so investment strategies, let's see what time it is. Market timing, attempting to sell and buy low, that's what all the people talk about, but it doesn't really work. All right, this is a quote from the Dalbar report, which comes out every year, which shows they track what actually happens to the average investor in America compared to the benchmarks that go out in the market. So in the last 30 calendar years, the S&P 500 compounded annually, so if you divide it out and make it an annual return, it got 11.1%. In that same time, the average mutual fund investor, not the mutual fund itself, but the average investor in those mutual funds, they defined it above, and that's just the person that's investing in a mutual fund in America, achieved a return of only 3.7%. In other words, actual investors actually earn barely more than a third of what they could have earned. So why this happened is people were buying and selling funds, and they bought when the market was they bought when the market was really high because everything looked really good. And then when the market was tanking, it probably had already got really low when they ended up selling. And then they kept their money out of the market till it got big. Oh, the markets are doing good. And they bought back in high again. So the average investor in America got a 3.7% return according to the Dalbar report if they would have just stuck in the S&P, which isn't even the greatest way to invest. Just stuck it in there for those 30 years, they would have made an annualized return of 11.1% and not had to move anything in or out ever. No question. Should I move my money? Just stick it in there. And to me, it just doesn't make any sense when you read. And the more you read about it, the worse it is that the people get by moving their money around. All right. Paul Merriman wrote an article, they say over a decade ago. I don't know about that, but I just read his current stuff. The buy and hold strategy, which you just buy investments that are worth holding for a very long time, which I guess Warren Buffett made famous, that type of line and verbiage. And earn excess return, so earn above like just that average market return through asset allocation. So invest in certain parts of the stock market that almost always outperform, say, the S&P 500. We'll talk about that a little bit more. And then, as you get older, you're going to have to start shifting your asset allocation based on life stage. So what that means is kind of back to your bond question. As you get older, meaning probably in your 40s and 50s, you need to start reducing the percentage of your portfolio that's saved in stocks. and start moving it into bonds. And it'll be different based on different person's needs, but you're going to start moving to a strategy where you can get income off the portfolio instead of just growth. So that when you go into retirement, you can get money, money, money without selling all your assets. And you want to reduce the volatility a lot by doing that. So we'll click on and look a little bit more here. All right, I'm sorry this report is terrible for you guys to see, but then I decided, Dan constrains himself, he says, I think to like one Greek word per sermon. I'll just constrain myself to one beautiful Excel sheet of sermon. All right, I'd like to put like all these up there, because this is what shows you the real things. And I'll give you the link so you can actually see it. But what this is this is showing what 100% bond portfolio has performed over the last 40 years. This is a 90%, 10, then this 10% change all the way to 100% stock over here. And then this is just the S&P 500 as a benchmark. So the idea is that if you use what Paul Merriman used as his diversified portfolio, which you can get by investing in this, like a wide pool of funds, which I can show you, which are available almost any of the major investment companies, Vanguard, Fidelity, Schwab, probably your own 401k. This is what you can get if you would invest in based on his asset allocation. At the same time is reducing your standard deviation or your volatility, which means how much it'll go up or how much it goes down in a given year. Mainly you're focused on how much it could go down in a year. You don't really care. You're like super excited when it goes up. All right. Try to contain my excitement. All right. So if you started by saying that you wanted to invest just like in the S&P 500, the annualized return over the last 40 years is 10.4%. That's what you would get if you would have invested over the last 40 years, which is pretty good. You'd have made a lot of money. And the standard deviation, that was good. The standard deviation is 15.5%. So that means from the lowest to the highest, that's what its standard moving up and down does. And the worst 12 months, the portfolio would have dropped 43.3%. In the worst drawdown, like any one drawdown, was 50%. Would have been lost in one click. There's a lot of investors that sell when that happens. Because it's not easy to see a portfolio that at 20,000 or 100,000 be, 50,000 or 20, half in one day. You wake up one morning, you're like, oh, I've got a $100,000 portfolio. You go to bed that night, it's 50,000. And it's hard to say at that point what the accountants would say, oh, you haven't lost anything. You still own the same amount of the company. Most people don't feel that way. It's only if you sell that you lock it in, But anyways, this is how it gets better. So then you say, oh, I'm going to go all the way in bonds. This is the numbers here for you. If you would have invested 100% in bonds, you would have got an annualized return of 6.4%. And the standard deviation would only be 4.2, meaning your worst drawdown was 4.5% of a whole year. And at one time was a 5.5% decrease in one day. You can live with that pretty easy. Like, yeah, I can do that. But then calculate how much money you would have only at a 6.4% return. So then you start moving through this process and moving over. I'll just go over to the 50-50 because we don't have all night. You get the idea. Annualized return at a 50-50 portfolio is already 9.5% return compared to just the S&P 500, which was 10.4%. And the worst 12-month drawdown was only 28% compared to 43%. That's about half with almost the same return. Now, if you jump one over to the 60-40, you're actually slightly outperforming the S&P 500, and you're at a 9.2% standard deviation, which means the worst drawdown was 38%, and the worst 12 months was 33%. So it's a lot less number-wise. So by using a diversified portfolio, you can get even better returns with less risk. That's the whole point of this slide. Is you can make, if you diversify and you buy investments that have, over the long period of time, outperformed, like buying the whole stock market, like an index that does a total stock market, you do better. All right. Comparing portfolios. Investing are maxed, because all these are numbers are off. If you just maxed out your Roth IRA for 40 years, that's what Pastor Henderson said. Just go with that, keep it the same so everyone can see it. In the buy and hold strategy, buying at Vanguard, and you were putting it in 100% stock, which of course you need to reduce, but we just put it in there, which would compound at 12%.
What's the max you can put in a Roth every year?
5,500 for anybody under 50, and 6,500 for anyone over 50. And you can also contribute to traditional IRA, but we'll get onto that in a little while. So if you would have invested in the Paul Merriman's advice compared to 4 funds that Mr. Henderson asked me to show as representative of like an average retirement fund, I believe he holds some of those, I'm not sure. For 40 years investing that way, the difference would be $3,485,000 less. And those are good funds. Those are performing at 8.6% compared to 12%. That's a good return, but still, that's huge. So we'll just get a little visual on that. That's the difference. We're going to get into the chart land now. All right. So Vanguard buy and hold strategy there. It's a little bit better. And this, you know, you can just do it yourself. This isn't like I'm selling you a product. It's you go do it. Buy extremely diversified portfolio, hold investments from a huge part of countries of the world. Kind of fun. All right. Results from 40 years of investing savings, $5,000 annually at various rates of return. That just gives you a visual of what it does to get higher return. Just let you look at that for a few seconds. You guys read that? The $200,000 would be your initial investment, it says. So if you invested $200,000 total.
Is that just the $5,000 times 40 years?
Yes. Mm-hmm. That's how many dollars you put in. So you would have put in $5,000 each year. And then it gets down to if you got 10%, which isn't as high as what the 100% portfolio would have returned, you've still got $2,292,000 in that portfolio from just putting away $5,000 a year.
Are you going to talk about what happens by waiting?
Yeah, that's a little bit further. All right. And there's the investment chart of the same thing you just saw. That's how much, because see, you invested the exact same amount of money, but it increased differently based on your percentage. Not very common. All right. So if you, this is what Mr. Henderson asked me to do about your weekly savings. So for example, say Sunday night rolls around after, or Saturday night for you guys rolls around after church. You're like, where are we going to go out to eat? And you go out to eat. And it sets you back $10, which I'd say is not that bad nowadays. Maybe it set you back more. And you do that for the next 40 years because at the CF churches we say, come live with us and die with us. So be together for the next 40 years, no problem. And we're eating $10 a week, but you decide, hey, we're going to reduce that somehow by $10 a week. And we're going to save $10 a week for 40 years. You have, not too bad if you put it in a savings account. It's the difference between just your average bank savings account, which is 0.2%, which is actually pretty good. I picked like one of the higher ones, so you made a good choice. You'd have $21,000. But if you would have put it in your Roth IRA, making only 9.5%, so I picked a low number to keep it conservative, you'd have $238,000 plus dollars. So by not going out to eat at your work with your coworkers, or not drinking your soft drink on the way to work, or however you want to save $10 a week, which I'd say for most of us wouldn't be that hard. 40 years from now, you'd have almost $250,000. No, more than a quarter. We're good. All right, start saving now. The difference between saving for 40 years versus 39 years, I'm still doing that at the 9.5%. And this is if you were maxing out just your Roth IRA, the same as always.
Hey, Rodney,
Mhm.
people don't know what's a Roth IRA.
A Roth IRA is a fund that the government's put together.
What does IRA stand for?
It's in individual retirement
Out.
account. There we go. IRA. So there's the Roth IRA, which means you pay the taxes when it goes in. But I have a slide about that in just like 2 minutes.
Oh,
But we'll talk about that in a second. Tax cards. You'd get 1.238 million or 1.364, but this is more enlightening. The cost of waiting 1 year is $126,000 upon your retirement. So if you decided to push it back for 1 year and not start saving today, say I'm going to wait 1 year and do this or that, that's what it is. All right, now it's at this point I'm going to talk a little bit about debt, because a lot of people have college debt, unfortunately, and you need to pay that down. Now if you have high debt, like credit card debt, or things with probably over 6%, just throwing out a number, and it'll vary per person to person and the amount you have in that debt, of course. You want to pay that off just immediately, because you'll be making more money by paying the debt off than you would be by investing. But once you get to a certain point where your debt is low interest, say 3-4%, you'll want to start saving at least a minimal amount, because on average the stock market will give you 9 to 12%, depending on your portfolio average. And your debt's only costing you about 3%, but the big key is that you're putting it into a tax-protected account. And these tax-protected accounts have maximum contributions. So if you wait to start saving for 3 years and just pay off all your debt really fast, which is a great idea, which maybe some of you should do that. That could be a very good option. I'm not saying not to do that, but it's something to consider. Instead of start saving at least a little portion of that into an investment, 3 years from now, you can't take your entire amount that you used to be paying for debt and start putting it into tax-protected accounts, because they have maximum contribution limits per year. So that's something to think about. All right, here we go. Here's a little spiel on the IRAs. As I said before, it's an individual retirement account, and you can currently, this is inflation adjusted. As you live, the government's going to keep raising the amount you can contribute. At least that's what they've done in the past. Up to $5,500 per year per person. So if you're married, each of you could have your own, because it's individual, retirement account. And so that means if you're married, you could save currently, if you're under 50, $11,000 per year in IRAs, which means, as they say here, we pay taxes now and not on qualified withdrawals, which I don't mind up to a year on that. You can't take your money out of a Roth IRA until you're 59 and a half. So this is why it's a retirement account. This is not an account for you to be saving up to buy a replacement car or to buy a refrigerator. This is for your retirement, so you can't just throw all your money at it. You can go ahead and open a brokerage account, or just have a local checking account, which is a good place to put your money in. Go ahead.
Is there a minimum amount?
Now, that's a whole different question based on banks, not government regulation. Most, Vanguard, for example, just throw their numbers out there, requires to open a mutual fund account $1,000. But if you want to invest in ETFs, which I think is the lowest cost method to invest with a small amount of dollars, you need $3,000 to do that, to buy that type of account. And then you could, of course, invest that all. But if you were investing in mutual funds in a wide portfolio, as I said, at Vanguard, for example, they have a $3,000 minimum per fund. And if you need to be investing in 12 funds, that means you're going to need about $14,000, $15,000 to get a complete portfolio.
And both spouse and husband can max out Roths, right?
Yes. Mm-hmm.
And is it better if you are under 401k to switch to Roth, if you can?
Yes, I'll talk about that, I think, on the next slide. I'll get to that. So, that is, so the idea is with the Roth IRA is you just pay that after-tax money. So you get taxed completely the same as if you spent that money at the grocery store, except it's saved. But the idea with the Roth IRA that makes it so powerful, quote unquote, is that it allows you to not pay any taxes on all the increase in this investment, and you don't pay any on when you take that money out, as long as you're 59 and a half. Now there are certain things, like if you get to buy your first time home, you're allowed to withdraw up to so much against it without a penalty, and there's whole things, as they say, go talk to your tax advisor about that. I could probably do that too if you like. That's what actually more credentialed for than this, actually. So, if you went ahead and did that, and waited till you're 59 and a half, no fees. But here's the other piece of it that most people don't realize, is Roth IRAs, when you pass away, they don't get taxed. Your children and descendants can continue to take withdrawals from them for a limitless period from as far as current legal standpoint at no cost. So it's one of the best money passing on tools you can come up with. Talking about leaving an inheritance. Leave it in the Roth, don't leave it in your traditional IRA. Because your traditional IRA, you'll be required to cash it out. Alright, so traditional IRA has the same contribution limits, has the same catch-up rate for anyone over 50, but you get to write it off your taxes this year as if you hadn't earned that money. It's a deduction. So you can reduce that, and it means you pay a lot less taxes to the government, so theoretically you could contribute more dollars to the account, which would allow you to have more money in there to build. And that's the idea behind that. But when you hit 62, you start required to take minimum distributions. And say that that investment had grown to 4 or 5 million, you would be getting taxed probably twice as much in your retirement as you ever did in your high earning years. It's very common for people that invested, the disciplined approach for their whole life. Which, if predictions about tax rates going way up because of the government spending far more than it's earning right now are correct, tax rates are going to be a lot higher then. So you don't want to be paying taxes then, you want to be paying taxes now, unless you're in a very high earning income bracket. So say, for example, you're earning tons of money, which would be great, then you need to take that money and put it away so that you can drop a tax bracket. That can save you a huge amount of money and be completely worth it. And a lot of people, when they get into their high earning years, they max out both their traditional IRA and their Roth IRA. So that means you could put away, if you were married, like $22,000 a year into a tax protected account, one each side, and reduce your tax liability by $11,000 of income, not of taxes. Mm-hmm.
So these are tax protected in what sense? You pay taxes when you put it in, or you pay taxes
When you
get
put it out, but you're not paying it either when you're putting it in, or if you get it put it in a Roth, which is my favorite, you're not paying it on all the growth. So for example, those few slides back where you contributed it in actual dollars, $200,000, and you now have like $2.5 million, you never pay taxes on anything more than those $200,000. But now you have 2-point-something million that you could spend tomorrow with no tax consequence whatsoever. So that's also really wise to be able to give it away, or leave it so when you pass away, it could go to the work of the kingdom without being wiped out tax-wise, because other than that, inheritance tax can set you back huge depending on your portfolio. 30% is not uncommon.
So like with the UK's 401k,
Mm-hmm.
do you have the choice to not make it tax exempt right now?
No, not if it's a 401k, because a 401k, generally, they're called traditional because that's what's been going on for a long time. It's equivalent to a traditional IRA, except it's sponsored by your employer, and that's why it's called a 401k. So when you retire, or if you quit, you could immediately roll your 401k into a traditional IRA, meaning that now you could manage it in whatever company you chose to put that money in. So it's the difference of who's sponsoring or endorsing this plan. Because the 401k generally has the match of your employer. Like I was saying earlier, your employer goes ahead and gives you, you say, all right, I'm going to contribute 3% of my salary, and they'll contribute an additional 3% to match that, which means you're now saving 6%. Some employers I've seen go up to 6%, which is great. UK is 5%, so that's wonderful. So if you put away 5, they're putting away 5, you're saving 10% of your salary.
Good question.
Go for it.
So when you do the rollover,
Mm-hmm.
you do have, the employer used to take care of all the fees, right?
It depends. That's the other thing when you're getting in, like I'm saying, you want to look at all the fees associated with them. They'll give you a giant book. They'll tell you everything about it. They'll say how much it's going to cost to get in, how much it's going to cost to get out, or move your money to a different company. And you want people that don't have fees. But a lot of employers, it's not uncommon for them to have a $100 account closing fee. That's run of the mill. Yeah, especially UK's has a lot of closing fees. So if you tried to move your money out when you retired right away, you're going to probably lose a lot of money in that process, unfortunately.
Next question.
Mm-hmm. Go.
Is it easy to switch from traditional IRA to Roth?
You can do transfers. You can roll from a traditional to a Roth, but you have to pay taxes on that amount. And usually, well, we'll just say it depends on your tax bracket, but it's very often not beneficial to switch. So what you want to do is just leave that money in there, and you'll pay taxes on it when you get to retirement. It's a good account to have. But for us young people specifically, the Roth is a lot better because we're in low tax brackets. Now say we get 30, 40 years old and we're getting really high tax brackets and it's killing us tax-wise, we might want to switch over to the traditional IRA to reduce our tax burden. Great idea. Or put it in both, put some in each. That's not a problem. Now here's the other thing going back to the 401ks. A lot of employers now are just starting to introduce Roth 401ks. Because they have so many tax benefits, that are unique to them. And so check with your employer to see if they offer a Roth 401k. Especially for young people, that should be something you should consider pushing in your job. Put in an official request and ask the people that manage it, why can't we have an option between a Roth or a traditional? Because from what I've seen, most of the time it's essentially the same administrative work for them. It's just the designation and the tax way, what's happening.
Should you always roll over? You've had several
Employers, all right, so if you're quitting your job and moving to another place, usually you want to get your money out of there because,
there's nothing on hand to actually generate.
yeah, but the other thing is they say, well, as some advertisements talk about, if you're not there to be watching it, who's saying that your former employer has your best interest at heart and is really going to be working for you to make that money produce as much as it could?
Even if like a last employer like 6% or more,
But they're not going to continue
Right,
match
that's
because you're
true.
not putting money in.
Exactly.
So that money's going to be sitting there and hopefully growing, but a lot of times they're not really watching. So if you're really good at watching it and there's a lot of fees getting out, maybe it's fine to leave it there. That's going to be a very much individualized question. But usually you want to keep it kind of consolidated so you can figure out what's going on with it. Because as the stock market grows, and say you were invested in 12 or so funds, either ETFs or mutual funds, at the end of each year, or whenever you choose to do it throughout the year, I'm not saying in December, but like once a year, you're going to need to go in and rebalance the portfolio to keep the percentages right. Because you don't want these small cap investments that grow a lot faster than the large ones to become proportionally huge in your portfolio. Because then when the day of the stock market tanking, which it will come again, it comes every couple of years, goes down, your portfolio is going to go down even more. And you're not actually taking advantage of a properly diversified portfolio, if that makes sense. Any more questions? We're kind of running low on time here. All right. Let's see, is there anything else? That's it.
Well, I have a question on
Go ahead.
that. So is it a better deal to put money in a Roth IRA or my money market account or extra money to my UK retirement, like Fidelity?
It depends the fees that you're having in your Fidelity account. You generally want to get your match for sure. So if they're matching 5%, you want to make sure you're putting in 5% to them.
Yeah, got that.
Second, saying, all right, should I just keep, put my percent up to 10%, whatever it might be, 20% into my Fidelity could be a great option because it's already there and you've already got one portfolio and you don't want to have to take care of something else. But you want to look at how much it's costing you every year to be invested in Fidelity and how much it's going to cost you once you go into retirement to move those assets into income. So you don't want to just look now, you want to look at what it's going to cost you in the future too to be able to get the money out. Now the money market question is one I wanted to bring up. Money market accounts, especially online money markets that are FDIC insured, which means the federal government guarantees that if the bank goes under, they'll give you your money back. Up to $250,000. Generally give you a lot higher return. There's a lot of them online now, like Fannie Mae and some of these companies that I don't really like very well, but Ally Bank, I don't know, there's a lot of them. You can go on there and I'm going to give a link to several websites. Bankrate.com is my way of finding which banks offer the highest rate of money market. And so I use that for my emergency fund. So just say you have a couple $1,000 set aside to take care of an emergency. Your car breaks, your AC unit breaks, whatever. You need to have several $1,000s set aside for that emergency to come up, or you lose your job, whatever it might be. Most financial advisors recommend you have between 3 and 6 months worth of living expenses, not necessarily salary, saved in relatively liquid assets. Go ahead, Laura.
What's a money market account?
A money market account is where firms are taking your money and lending it to other banks to meet their overnight deposit needs, is one way they do it. There's other ways they can invest it in. Certain of them can invest it in very, very short-term bonds or government securities. So it allows them to get a lot higher interest rate than a just regular checking account. And generally you're limited to depending bank, totally depends, but 100 transactions a month. So you can't write checks out of it. You have to move that money, usually electronically, in and out of your checking account. And it usually takes 2 to 3 days. Does that help answer it? But that usually only makes about 3 or 4%. So you don't want to be saving money for retirement in there, when if you were investing it in a stock market, in bond funds, whatever your mix would be for your age, and your risk tolerance, you would want to go ahead and probably put that into either your UK plan, or open either traditional IRA or a Roth IRA, or if you don't want to put it tax protected. Say you're trying to save money that you want to spend before retirement. I don't know, say somebody wants to buy rental property, and you're I want to buy 4 houses, a quad or something, or even a duplex, I don't know, and it's going to set me back $200,000, $400,000, I don't know, but it's a long-term goal. And you want to invest it in a stock market, probably in relatively low risk, because it's not going to be in there as long. You would want to put that in just a brokerage account, which means it's just a regular account that you have access to buy and sell mutual funds, stocks, bonds, the whole gamut of investment options. And you can do that, with money you want to get in and out. And I know several people in the church that invest, I don't know, they call it chunk change, maybe a few $1,000s or maybe a few tens of thousands depending on the person, into that, and they'll pull it out at times and use it for church issues, or when they see an area of need that they want to give it to. So they just put it in there. But the disadvantage and the reason you don't do that for retirement is that it's not tax protected. every year, the gains you're making on that, if you would sell that stock, you're going to have to pay a tax on the gain. If you lose, you also get to do a deduction. So you can harvest your losses, as they call it, and offset your gains if you lose. Hopefully you don't, but you will have some funds that are going to probably lose at times. It's just the market. So everyone needs to realize the market goes up and down and up and down and up and down, but over the long haul, it goes up. At least historically it has, way more than it goes down. It just continues to kind of grow like a tide. Any more questions out there? Thoughts? I'm going to try to put together, I've got it mostly done, but I didn't want to just give it to you kind of unformatted. A PDF just with links to the websites for you to go do more reading. And I'm going to attach the link to download a Dropbox. I'll compress it and put it in Dropbox where you can just download it. And I'll have Paul Merriman gives away his PDF books. And they have a lot of, I'd say way more clearly presented than I do, information for you to read. And they have all the tables showing how he would recommend you invest at different life stages in that. On his website, paulmerriman.com, he has his recommendations for stocks, bonds, mutual funds. He has them for Fidelity, Vanguard, Schwab, all these different companies. But once you get a lot more money, it's very worth your while to pay an accountant, a CPA generally, and or a financial advisor, or both, depending your level of wealth, to help you plan it. Because just getting these things lined up correctly can way more outperform whatever they're going to cost you. And making sure you've got it well planned to either transfer wealth or be able to live the way you would like in the kingdom, because a biblical form, as I would say, of investing, which doesn't mean you invest any differently day to day, but the mindset behind it is very different. I'm not trying to invest so I can make, $10 million and be able to retire and sleep all day. Or go golfing, whatever people retired do, I don't know. My grandpa always says when you retire, it just means you got new treads and you're ready to go again. Just like when you retired. So he said you can work more than. But anyways, we need to be kingdom-minded and focusing on that. And I'll just go ahead and pray to close this unless somebody else has another question. And people can ask me questions or seek, excellent advice. There's a lot of people in the church that have experience in these areas too. And